All right, we are talking markets in this segment and what I expect kind of moving forward. Going back to October 12th, I posted on Twitter that I had maximized my exposure to the markets to the maximum of my abilities in terms of risk parameters. Um, October 12th, the market bottomed on the 13th. I hadn't had that much exposure since March of 2020, and prior to that, in 2008, 2009, where I feel my edges lies with market sentiment and positioning being what I considered offsides and very offsides. Those are where I feel like I have the edge. At other times, I don't feel like I have an edge, so I'm not aggressively positioned. I let my 401k and my spot Bitcoin holdings do their thing. But at at these specific times, this chart was telling me a story. And so, what was the story it was telling me? It was telling me that if I pull up the monthly chart of the S&P, if I pull up a 50-month simple moving average, you go back to 1933, and this has told us a lot about what is currently happening. So, are we in a bull market and simply making a bull market correction, or are we at the start of a bear market? And if you were watching CNBC or talking to your friends and um, listening to the analysts, the consensus was we have a lot more room to go down from this position, right? Recession is imminent. Everyone is concerned about what's to come. Fear was at pretty high levels. Cash positioning by hedge funds were at all-time highs. But also, what we had was unemployment near record lows. When you consider 85% of daily volume that's traded is passive flows, 401k pensions, and the market has positioned itself for further downside, my stance was the path of least resistance is a sharp correction in the opposite direction than everyone is positioned for. And so far, that is playing out. Okay. But what led me to believe this back then? Well, if we simply look at this 50-month simple moving average, a breach and a failure to reclaim has constituted the start of a bear market, right? 2-year bear market here. A breach, but it reclaims, continuation. A breach reclaims, continuation. So this is simple bull market correction. Bull market correction. Back into 50 SMA, bull market correction. And look at some of these gains after you take in a reclaim of this 50, 194% gains in the S&P in the next 3-4 years. From this point, 400% over the next 8 years. What happened in 2001? Well, you had a breach, you had an attempted reclaim, you had a failure, and you had a rejection. That was the start of a bear market. July 2001 lasted all the way through to when it reclaimed here, August 2004. That was a signal of the start of more pain, right? What about in 2008? You had a run into the moving average, a reclaim, a failure, a rejection underneath, and that was the start of a bear market, right? That lasted several years. We then came out of it, retested, reclaim, bull correction. Bull market started again in October, November 2010. We got a reclaim and continuation, bull correction. And from that moment on, 135% appreciation in the S&P in the subsequent years. When did we have this occur again? And this is my favorite of all, right? So you had the world economy stop. We had everything shut down, and still these markets could not breach the 50-month simple moving average. I mean, if that doesn't tell you something, the force of this move, right? The force of this bull market that started I don't know what does. Stopping, again, the stopping of the world economy could not make this breach that moving average. And so subsequent to a reclaim, we saw 79% gains within a year. Just incredible. And then finally, what we saw last fall, we had again a violent move down. And the key here is to think about this like a spring, right? You got force applied to elastic objects, and markets function a lot like that in my mind. There's a lot of parallels to be drawn in physics and in markets. You've got market forces, right? The Fed tightening, you got the war in Ukraine and Russia, and you've got worries about recession, you've got inflation going up, and you've got all these forces on the market. And this market, that was a nasty correction. That was a nasty correction. But it, in my opinion, was simply a bull correction, right? That's what I'm seeing here. And in situations where you do have a nasty correction, everyone has been a V here, right? Show me where it hasn't been a V. These are all V-shaped recoveries. And so why would this not be a V-shaped recovery? And that's what we're seeing play out, right? If you look at the angle at which we're coming in, okay, and the angle at which we're coming out, that's about the same, right? With the same force that's applied is equal to or greater force that's going to be exerted. That's the spring effect, Hooke's law. And so we're seeing that play out in markets, okay? And so far we're about 25% off above this corrective level, and I think we got a long ways to go. I think this is just the beginning of where I think these markets truly see its climax, its culmination, well above these levels in the 6,000-7,000 range. Wouldn't surprise me at all, and I'm expecting that to happen fairly quickly as well. Let's look at another point of confluence that kind of supports this idea as well, and that is the NASDAQ. All right, so I'm going to pull up the monthly again. We're going to be looking at some candles. And these are from when I posted on Twitter when I maxed margin positions based on some of the things I talked about on the chart previous and based on what I'm going to share with you guys right now. So again, it's been my belief that we have not seen the true blow off top in these markets. Okay, that's my contention. That's my opinion. I don't know if that's what's going to happen. None of us do. We're all just speculating in terms of direction. However, if I just look at market structure, right, it tells a story to me again. The bull market that led to a blow off top in 2020. That's what a blow off top looks like to me, right? This did not exhibit the traits of a blow off top. This exhibited the traits of what you might see in that parabolic curve euphoria chart, a first sell-off into your final parabolic real blow-off top. When I throw up the Bollinger Bands on the monthly chart, I just love this one. I really do. It tells you a lot. Let's zoom in here and kind of triangulate on what I saw last fall with the S&P with what we saw here on the monthly, right? You've got a range high top Bollinger Band back to the low end of the Bollinger Band, still within the context of this longer structure. You've got a back test and go scenario, right? Back test, kind of like two tests and go. And once we reclaim this midline of the Bollinger Bands, to me that was confirmation here, and at least we're headed to 15,900 prior to any type of meaningful correction before what I expect in terms of a real blow off top in these markets. And so those that have been following me on Twitter have seen this chart since last September, October, November. Things didn't look so great down here, but now as I've expected, as the force of the move in is starting to match the force of the move out, much like a spring that's uncoiling, with at least the same amount of force, if not greater. We're seeing that in the form of this V-shaped recovery. Okay. Now let's just look at a couple other points of confluence. You don't, on high time frame, you just don't see these setups very often, right? Where you've got, MACDs that the histogram gets down so low, and you've got, you just got this coiling structure right here. And this is our third green monthly, right? That typically, marks the start of something, right? If we're looking back, and we don't see these very often, where you're really coming from a position of negative bullish crossover on the MACD, the histogram start moving into green and positive territory. And again, this just tells me this is the start of the move, right? I'm not looking at, these NASDAQ positions that I've been accumulating and saying, all right, where do I start to trim? That would be like me saying, where do I start to trim, back here, right? In this area, or where am I starting to trim, in this area, right? Where this move just kind of got started. And even if the time frame is wrong, right? I'm not trying to day trade these things. I make like 10 trades a year, right? I've got a day job that keeps me busy. And so, I'm looking for the long-term move, right? And the long-term move, and the long-term move. And if it happens sooner, great. The long-term moves, right? And so even if we don't get a true blow off top here, this still tells me this is the beginning of a secular trend that, yeah, maybe it extends a little bit longer. I still think it doesn't, given positioning, sentiment, disbelief. We're kind of climbing that wall of worry. Unemployment at record lows, meaning passive flows are coming in. And the positioning from last year, hedge funds and folks that were short the market or out of the market don't just, YOLO in on a day and say, all right, we're going to regain our positioning. We're going to enter the market. We can't afford to stay flat while the NASDAQ has posted 40% gains in the first half of the year. That's unacceptable to the funds performance, to individual career risk. So as those folks start to allocate, 5% positions amongst 20 different ideas, they go in at 1% at a time, right? Here, we're going to start at 1% and buy on pullbacks. And so as that starts to come to fruition over the course of months, and retail isn't here, and retail says, all right, this is a new bull market, right? Let's keep this going. That can feed on itself. It really can. And so final point of confluence in terms of the blow off thesis is going to be the dollar. And this has been telling me a story for a while now, right? For a while now. And let me just go to the weekly chart. And we're going to take a look at a few things here. Okay. I'm going to pull that down for right now. But again, on high time frames, Bollinger Bands just tell me a lot, right? They tell me a lot about trend, about direction. This tells us a lot. That's a parabola, right? There's no mistaking what this is. That's a parabolic move. Okay, the dollar hasn't seen that type of move in when? So 2014, 15, close, but this one was still greater in magnitude. But let's see what happens in risk assets, and most specifically, the risk asset that has the most beta to the NASDAQ has been Bitcoin. And so to me, what we're looking at here is, and just imagine this is a 15-minute chart, right? We've got a range high that goes back to 2016. We've got a range low, okay, that goes back to 2018. We had a range high to range low move in the dollar. We had a range high and a range low move to the dollar. We had a range high, breach range high, parabolic. One could argue this is one massive deviation. Now we're back inside the range. Okay, and this is a corrective type triangle structure where I think I'm removing this because I don't think that's playing out any longer. I think with this weekly close back under this range high, E is in. So we've got A, B, C, D, E, and then that completes the corrective triangular structure, which typically resolve to the downside, and that takes us to, in my mind, range lows of 89. Now, how is Bitcoin done in this environment when the dollar has ended its corrective phase and headed down towards range low? Well, it shows you right here how it's done, right? Bitcoin from this point, right, which you can kind of argue, you got the Bollinger Band retest, trying to retest it again and then fail. From this moment to range lows, Bitcoin did a 10x. Similar structural point right here, right? You've got a attempted kind of back test, but doesn't quite meet the midline, and then heads back down to range low. Bitcoin did a 7x. So here we are here in a more complex corrective type structure where we got the back test of that midline Bollinger Band, failed, but then it reclaimed, but now failed to reclaim the midline, and I think we're headed lower. Near-term target would be about 101, 100, bottom end of this band. Then I'd expect it to breach and fall much further. And so I submit, if in these environments, and I think the Bitcoin is more closely correlated in recent times with the dollar's relationship to other currencies than the halvening. And so liquidity, the strength of the dollar in terms of global liquidity, I think is more correlated. It's almost like a hedge, and go figure. Go figure. So that's what I'm seeing on the high time frame on the weekly with the dollar. So that was my quick macro market update. I hope you all enjoyed it. I'm going to keep doing these. Share, like, and subscribe to this channel if you enjoy the content. Have a great weekend.